Good morning and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, March 31st, 2020, and we are pre-recording this Trading Places Live. Currently, futures are pointing to a mixed open, but we do know how things can change quickly in this environment. This is the end of the quarter, end of the first quarter. And it looks like, unless we have a major reversal to the upside, it looks like it's going to go down as the worst first quarter in Dow Jones history. It has been a very difficult ride, and really it's all happened since the middle part of February. So it's only been the second half of this quarter that's taken us down. But we are where we are. We got a lot of ground to make up back to the upside, but it's probably going to be, it's probably going to take a while for us to get there. Let's go ahead and talk a little bit about what we're going to look at today. First, we'll get into the daily market recap from yesterday. We did have a pretty good day. It was down a little bit early, or maybe a little mixed, but we did pretty much move up throughout the day, closing at or near highs across our major indices, so that was good. Talking technically, I want to talk a little bit about the 10-year Treasury yield. We might get into the S&P 500 a bit as well. Maybe look at some of those Fibonacci levels, see how close we're getting there. Talk also about accumulation distribution. This is an indicator developed by Mark Chaikin. It's available at StockCharts. It's one that I've used in the past somewhat, but I've really grown much closer to it. Given the current environment, I think it helps us see a little bit more about what's taking place during the trading day, because we've had such wild moves at the opens throughout the last month, maybe last 5, even 6 weeks. And so I think this helps us gain a little bit better understanding as what's taking place during the trading day. So I really like the accumulation distribution. We'll talk about that. Earnings spotlight, not a whole lot going on there, but there is a company reported last night, down quite a bit this morning, 13%. And got a couple of upcoming earnings reports I think are going to be very interesting later in the week. So we'll talk about those. Upgrades, downgrades, just a couple there to go over, and then we'll wrap up with the 3 you must see. So first, let's go get into the daily market recap. It was a good day on Wall Street, so we are trying to continue that rally that we've seen here over the past week or so. Dow Jones Industrial Average up more than 3%, up 700 points, nearly 700 points. Back above the 22,000 level, and we're trying to get through that 20-day moving average. The S&P 500 up 3 1/3%, NASDAQ 3.6%. Mid caps and small caps underperforming again, though, 2.5% and 2.3% respectively. Looking at the various sectors, and I want you to focus on these top 3, because these have been 3 of the best areas since February 19th: healthcare, technology, and consumer staples. So these are probably going to be 3 areas of the market that you're going to want to take a look at. Even on the down moves to the downside, I think these are 3 areas that may continue to see outperformance. Utilities had a pretty good day yesterday, and communication services as well. So all in all, good day, trying to continue that push to the upside. 10-year Treasury yield. Now, first I want to mention that the February pending home sales came out yesterday. Rose 2.4%. Market was expecting a drop of 1.6%, but before you get too excited, it was February. So a lot of what was going on, or a lot of what's going on in the market, really we started to see the impact in March. So any of these economic reports coming out from February or prior, probably maybe just, I don't know, take with a grain of salt. It doesn't look to me like the market cares too much about what was happening in January and February. I think we're going to be turning our attention to what is happening in March and beyond. And with respect to that, I think there are going to be some big reports out later this week that are going to be shocking. And the market, I think, is anticipating, but it's still going to be shocking. We've got ADP employment coming out tomorrow morning, PMI manufacturing, ISM manufacturing, both out tomorrow. We got, of course, non-farm payrolls coming out on Friday. It's going to be a lot of news. It's going to hit the market. And now that we've seen the bounce, the question is, can the market handle it, or are we going to go back down for that move to the downside? As far as the 10-year Treasury yield, I always like to look at what's going on in the bond market when we talk about economic reports, because the bond market uses a lot of these reports, forecast what they expect in the economy going forward throughout the balance of the year. And then we get a little bit of a clue as to, what the bond market is thinking based on how the treasuries trade. 10-year treasury yield right now at 0.67%. That is as of the close yesterday. I was looking this morning. Right now, we've got the 10-year treasury yield up about 2 basis points. So 0.69% is where we're currently sitting. But we have rolled back over. And I just wanted to point out normally what we see, the relationship between the bond market and the stock market normally is opposite. If you're going to put money into the bonds, that's money you can't put into stocks. So bond prices and stock prices a lot of times will go opposite. Well, bond prices and bond yields go opposite, always go opposite. So if bond prices and bond yields go opposite, and bond prices and stock prices go opposite, then we should see the yields and the S&P 500 going in basically the same direction. And that's what history tells us. I mean, here's a correlation. This is just going back the last 3 years. And this is a daily chart. And it's not perfect. If we showed treasury prices and treasury yields, it would be a perfect inverse perfect inverse correlation, be -1. Here you can see that for the most part, the yield and the S&P many times carry +1. We certainly hit +1 a whole lot more than we hit -1, very, very rarely on a daily chart. But the point here is that when I break this down, and I know what the longer term correlation is, but when I break this down and look intraday, this is just the last few weeks, what we've actually seen in terms of correlation is a little bit of positive, but here we actually went to a -1 between the 10-year treasury yield. You can see how the yield's going up and equity prices keep going down, even during the day. This is very strange to see the yield go up throughout the day and the equity prices go down throughout the day. You got to think about what this means. 10-year treasury yield going up means that treasuries are being sold. Normally when treasuries are being sold, that money goes into stocks. But in this case, treasuries are being sold and stocks are being sold. So there's a lot of folks out there nervous and would just simply rather be in cash. And I think that's important to consider as we go forward. 10-year treasury yield since March 18th, 19th, the yield's been dropping. So that means money's been going into, back into treasuries. Normally that's not good for the stock market, but the stock market's been bouncing along with it. So we're actually in negative inverse territory or inverse correlation, negative correlation territory here, down at -0.67. That is likely to change. So one of two things is probably going to happen here pretty soon. Either we're going to see the yield start picking back up to coincide with the stock market going up, or we're going to see the stock market begin to roll back over. Now, as far as the S&P 500 goes, I'm going to go ahead and pull this up on an hourly chart. And let's go back and look at this over the last 3 months. And now let's annotate. And let's take a look. This isn't going to be exact, but it'll be pretty close. Now, what we saw in 2008 and what we saw in 1987 was the S&P 500 after panic sell-offs getting a bounce into this 38.2% area, Fibonacci retracement. I think one of the years intraday we went up almost to 50%, then reversed back very quickly. So I would be looking for potential reversal signals in the market. I mean, if you're trying to time the market as a trader, I would be looking for reversals in this zone. We're almost there. And I know it seemed like back when we were at 2,200 and I said, hey, this rally, when we get it, could go back to 2,650 or even as high as maybe 2,800. It seemed like, wow, there's no way we're going to do that. Well, here we are a week later and we're there. Now the question is, can we continue to move through this level? That would be bullish if we could. Now I'm also drawing this line right here. Do you see this gap down? This is where, we had a gap down, had a quick recovery, and then really took off to the downside. This is a key gap resistance area, and it's somewhere around the 2720, 2730 area, I believe. Actually, let's get out of this for a second. And I'll give you this number. 2740, 2741. So 2741, keep that in mind. This reaction high right here was 2710. So we got 2710, 2741. The Fibonacci retracement was 2650, up near 2800 was the 50%. So we're moving into a territory with multiple levels where we could see a reversal. And I would be very careful in this area as a trader. If you're thinking, if you shorted on the downside, now you're long, first of all, congratulations. That's been a great timing. Most, I would say, have not been that fortunate. But if you are short-term trading, this is an area that we are getting close to that I think we should be paying very close attention to. All right, let's move on. Talking technically, I want to get into accumulation distribution in just a couple of minutes. But in this talking technically, we just looked at the S&P 500. I want to pull up the XLV. I want to pull up a couple of these sectors and take a look at them as well on this Fibonacci, using a Fibonacci retracement tool. So let's pull this up. And there's a couple of different levels. When I see a big rally like this, the question becomes, do you start the Fibonacci way back here, or do you start it from here? And so let's go ahead and pull up both, and so that you can kind of get a sense. That was about the top. That was right around that February high. And let's just say that we're going with this right here. All right, we're at the 50% level right now, and it would be 62% getting up to that next level, which would probably coincide with the overall market getting up into that 38.2 to 50% range. Remember, the XLV has been a relative leader. So we're seeing strength here, and that's why we're already up into this zone of Fibonacci retracement. Let's go ahead and take a look from this high. Now from here, you can see we're already past 50%, getting very close to the 61.8% level. So healthcare has clearly been an outperformer, and this is an area I would continue to focus on. I think I like to trade relative strength. I like to be in areas, especially if I'm on the long side, I want to be in areas that are outperforming the S&P 500. I don't care if the market's going up or down. If I'm going to be on the long side, I still want relative strength. So I think it's important to recognize, first of all, that the healthcare area provides us some opportunities. And I think will continue to provide us some opportunities. Next up is technology. Now, technology, I think the highs are a little bit more established here. This was right about when the stock market topped. And you can see technology has already moved into the 38.2% area. Still got a little bit of room to get up to the 50%. So again, the S&P hasn't gotten to 38.2, but technology has. So that again shows you the relative strength here of this group. But again, I'd watch 50%. I think if the market continues to strengthen here in the short term, it seems like the market's been a little bit more labored to go higher. And I think we got to, I don't know, I have to see how the market's going to react to these economic reports coming out. I know everybody is talking about them being bad, but there's still a sticker shock when you talk about some of the numbers that are going to be unprecedented that we see coming out, not just this week, but really over the next several weeks. And how the market's going to handle that, I think is going to be really important. So, but the other thing I would say is that if there's ever any kind of a breakthrough, any kind of a breakthrough, a drug, looks like that it can treat the coronavirus, having success, you could wake up on a short side, and this is the biggest risk, holding overnight. If you hold overnight and something comes out, I would not be surprised to see the Dow one day up multiple thousands of points. So that's the risk on the short side that you got to be prepared to deal with. Now, chances of something just coming out right out of the blue probably aren't that great, but you do need to be aware that I think it's a pretty big risk. All right, let's take a look at the last one I wanted to go over, and that's consumer staples. Now, staples, you can see during different periods, has had some pretty good pushes back to the upside. But I'm going to go ahead and annotate this and look from this level. This was a pretty big reaction. And then coming back down to this low. And you can see again, just like healthcare, we're back to about 50%, a little bit more room up to about 61.8%. That would be really bullish for this group if we could see a break above about 57 on the XLP. Certainly 57 and a quarter. You start getting up into that area. That would, again, on a relative strength basis, that's what I'm talking about. I'm not talking about, okay, if we break above 57, we're going to an all-time high. I'm just saying if we break above 57 in this market environment, I think that would be incredibly bullish for this group. And it kind of makes sense. First of all, it's a defensive area. Defensive areas tend to do well during bear markets. So that's got that going for it anyway. But there are some areas in consumer staples that actually will continue to benefit from a pandemic. I mean, you've got companies out there like Clorox that, you know, the Clorox wipes. I mean, if they had Clorox wipes on the shelves everywhere, it's hard to tell what the sales would be. I haven't seen any in my area in weeks. So, you know, you've got a lot of demand for companies in these areas. And, you know, maybe it's short term, but I actually think there's going to be a paradigm shift as a result of this pandemic. This is something that none of us have experienced in our lifetime, unless you're at least 102 years old. Was it 1918? We had the pandemic. So this is something that we have not experienced before. And I think there are going to be some major shifts. And we'll be talking about that actually later in the week. We have a show coming up that will talk a little bit about these shifts that everyone needs to be checking out StockCharts TV to be sure you see that. But there'll be a few of us talking about some of these various paradigm shifts and some of the things that we can be looking at and looking forward to over the next, maybe the next 6 months, but it might be the next many, many years. All right, let's keep moving on. I want to talk about accumulation distribution a little bit. Accumulation distribution, first of all, you know, kudos to Mark Chaikin for coming up with this indicator. I think it's a brilliant one, especially in an environment like this, where we're seeing everything's moving down, but that doesn't mean that everything's selling off. Even stocks that are down, a lot of times are down based on opening prices. The whole market is fearful. Everything sells off at the open. But then accumulation distribution can give us signals as to what's being bought during the day. It only looks at the current trading day. It doesn't look at where we closed at yesterday. That's the difference between accumulation distribution and on balance volume. They're both kind of measuring the same types of things, but on balance volume is simply looking at where we closed today versus where we closed yesterday. When you look at accumulation distribution, it's more about where you closed today relative to your trading range for the day. And so it's much more attention is paid to what's going on throughout the trading day, which I think is really important because we've seen so many gap downs. I've talked about this on prior shows. Most of the selling that's taken place since February 19th has taken place at the opening bell. If you take out all of the net gap downs, the overall market really isn't down much. And I haven't updated that spreadsheet here in the last week or so. So maybe it's down a little bit, but it's not down much, if at all. And so if we strip out what's happening at the opening bell and simply look at what's going on during the day, I think accumulation distribution is a great area or a great tool to use. So let's take a look first at healthcare. So if you go in, this is a scooter report. So if you go into your dashboard over here under member tools and you just go down to summary pages, scooter reports. There's your summary pages, scooter reports, click on that. Then type in wherever you could type in an industry group, you could type in a word, a keyword, you know, just type technology. That'll bring up not just stocks in the technology sector, but it could bring up any name of a stock that has technology in it. So it might be a healthcare stock, but it may have technology in its name. So whatever you put in the search table here, search box, is what's going to be brought up. So I just bring up healthcare. So what I'm really looking for are the healthcare stocks. Now this tells me some of the best healthcare stocks. And some of these at the top I really am fans of for sure. But I'm going to change this to go with scooter change. So now I'm looking at the healthcare stocks that saw a change yesterday. Then within that, I'm looking down here at some of these that have, you know, higher scooter ranks. So they're telling me that on a relative basis, these are probably pretty good stocks. They made a spike yesterday. These are some I might want to take a look at. So let's pull up the Cardinal Health. Now, first thing you see is, wow, it's not very good. It's been going down, so this isn't good. I don't know that I would necessarily go there. I think when you look at the filled candlesticks, this is where you gap down and continue trading down. We've had one really bad day in the last 3 or 4 weeks, right here, where we gapped down and kept selling off. Look at all these hollow candles where you're down early or you just finish above your opening price. So when I see a lot of filled candles, I think accumulation. When I see a lot, or excuse me, when I see a lot of hollow candles, I think accumulation. When I see a lot of filled candles, I think distribution. And though, you know, when you're looking at it, you might be able to visually spot it. The accumulation distribution line tells us what's going on. Do you see the prices keep going down? Here's a low, here's a low, here's a low, 3 consecutive lows. Here's the accumulation distribution low. Here's the next one. Here's the next one. Accumulation distribution's rising while prices are going lower. That is telling me that there is a lot more positive going on in the stock than just what your eye might show you from the stock price dropping. And you can see yesterday the big volume, the move back up through the 20-day. This is a stock that looks pretty good to me relative to the overall market. I mean, we're at 48. The you know, was at 60, so we're down 20% from where we were. And if we pull up the relative chart, you'll see that CAH, number 1 versus medical supplies, is going up, and versus the S&P 500 is going up. So you've got a stock that's in healthcare, which has been outperforming the market. You've got a stock in medical supplies that's been outperforming medical supplies, a stock outperforming the S&P 500, and the accumulation distribution we just looked at is showing a positive divergence. Prices are moving down, accumulation distribution is moving up. These are the types of stocks that I'm interested in trading. Now, does this mean that I would buy and hold 10 years? No, the accumulation distribution is, you know, it could turn down again next week. We want to continue to watch that. But as a short-term trader, when I know a company is trading off of its lows almost every single day, if I get a move down early in the day, it's going to give me some comfort, especially if I can find a key support area. Like right now, this stock has been printing higher lows just about every single day. So if it was down today and got down to around 46, I could get in with a pretty tight stop looking for that reversal. If it doesn't, I could just take a small loss. But I don't have to hold overnight. I'm waiting until the morning to get in. That's the way I've been approaching the market. I'm afraid of these gaps. Hasn't been bad lately. It doesn't look like it's going to be bad today, or at least last time I looked. Let's see. Right now we've got futures. Yeah, Dow futures down 40, NASDAQ up 8, S&P down 6. So it looks like it's going to be relatively flat open. But throughout this downtrend, if it starts over again and we begin to roll over and start to gap down, for the most part, I want to have my account protected at the open. That, as a trader, that's the way I'm approaching this market. If you're doing it other ways and successful, that's great, no problem. But it does bring in a lot more risk with the gaps that we have seen in the market. All right, so I just wanted to go over and show you using the accumulation distribution, using the tools at StockCharts, so many tools here. Make sure you take advantage of that. Earnings Spotlight. Let's take a look first at RH. This is a company came out yesterday. They beat on their bottom line. Of course, the market, as far as I'm concerned, could care less what you did in the last quarter. This is not about what you did last quarter. This market right now is fearful about what's coming, and the market's always looking ahead. So RH came out. Let's go ahead and look at the symbol summary, because then we can get the current pre-market, down 12%. So it is looking to open down $14.50 to 103.50. So if we go back here, 103.50, let's see what's going on the chart. 103.50 would be right here. I don't know where it's going to go after it opens. I mean, it's got a wide trading range from the 70s all the way up into the 120s. The 20-day moving average is going to be difficult for a lot of stocks. So I think your upside is limited here in the short term. And with the gap down, you know, maybe it rallies after the gap down, because a lot of stocks have, and this one has been doing pretty well over the last week. But the longer term chart here is, you know, not good. Dropping from 260 down to $70. That's much more than the overall market. So this is a stock that clearly has been out of favor, coming out with its earnings, gapping back down. This one seems to be rolling over to me. I'd be a little careful. You know, as far as the others, McCormick reported this morning, 108 versus 104. Let's just take a quick look at that chart. Nice move here, breaking back above its 20-day, and this is in consumer staples. Accumulation distribution, not as good as some of the others I've seen. You can see a lot more of these big red candles. You also have a lot of hollow candles. I think, you got gap resistance and this tail up here in the upper 140s. I think the upside might be a little limited here in the near term. Obviously, if it could break out above that and get through the 50-day, that would be awesome. I just don't know that I would count on that and take a position. So I'd have to see how this one trades a little bit. Conagra also reporting this morning. I did not see the numbers. They were expecting 49 cents, but I didn't see the actual. So let's go ahead. I do want to mention later this week, Walgreens Boots Alliance, WBA, coming out with earnings on Thursday, and Chewy, CHWY. Let me show you this chart. Look at stock breaking out. Now, this one I'd be a little interested to see what they have to say, but look at the accumulation distribution breaking out to, I don't know, maybe a 7-8 month high. It's been moving up all month, and look at all the hollow candles here. Very few filled candles. So again, if you're buying on these opening moves lower, some of them, we got some gap downs, but then we've got recovery. That's, again, what I've been looking for. So CHWI looks pretty good. Upgrades, downgrades, Apache upgraded, Dollar General upgraded, Oracle upgraded, Sirius Satellite upgraded, downgrades, Coupa Software, Honeywell, ITW, LYV, which is Live Nation, Synaptics, Teladoc, all downgraded. The three you must see, I tell you, I'm going to go with some industry groups. And in my Trading Places Live at Earnings Beach yesterday, I talked a little bit about some of the key areas that are leading the market. And I talked a little bit today about the sectors. I'm going to throw a couple of industry groups out there at you that I think have been really good. Delivery services. So let's take a look at the delivery services chart. Now you look at it and you say, well, it's been going down, coming, but it doesn't look that good. But when we look at what's going on relative to the S&P 500, and put that on a line chart, you can see the huge spike in March. So this is a group that since that February, and that's how I'm kind of quantifying these different groups, is where was it trading when the S&P 500 topped on February 19th? And where was it trading when the S&P 500 bottomed on March 23rd? That's what I'm using as a comparison. Delivery services, DJ USAF, fell 14% during that period while the S&P dropped 25%. That's why you're seeing this relative strength. Now, we have pulled back over the last week, but the overall market has strengthened. If we get weak again, I would be looking for a resumption of some of this relative strength. So watch this group. Another group in the healthcare space, pharmas. Pharmas have been doing very well. I'll show you again the relative strength here. Right on the February 19th move. Now remember, February 23rd was the point where the S&P hit the low. So throughout this period, we had a huge move higher in pharmas. Kind of makes sense given the environment. But while the market's been hot, we've pulled back a little bit, starting to regain some of that strength. So pharma is a group I would watch. And then finally, why don't we take a look at, I'm going to throw in there the best performing area of technology during this spot, or during this period. You might be surprised, is actually the telecommunications equipment group, which had been underperforming. But all of a sudden in March, we started to see a big pop on a relative basis. So this is another area you want to keep an eye on. All right, that is it for today. I'll be back on Thursday. Everybody have a great day, and see you Thursday. Happy trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.